Hi, you guys. I hope that you're having a fantastic day. Now, if you follow the news lately, you realize that inflation is at an all-time high. And actually, my video last week was about the number one thing that you can do to beat inflation. Now, one of the tools that governments have available to beat inflation is interest rates, because their opinion is like, okay, if we raise interest rates, people have less money to spend and it will drive down inflation. Now, that really affects a lot of people. Like I myself have a mortgage, and when interest rates go up, I have to pay more for the mortgage every month. At the end of last year in December, the official government interest rate in the UK was 0.1%. And today it's 1.25%. So I want to share with you some examples like what does that do to the average household if their mortgage goes up by 1.24%. So this is basically my mortgage play sheet. So it has a couple of cells here. So for the purpose of this example, let's say that we have a mortgage amount of £100,000 and you decide to borrow this for 25 years. And the interest rate that you got this mortgage for at the end of December last year was 3.5%. Now this means that every month you have to pay back £500 for 25 years. And then in 25 years, you're mortgage free. Many people think that their house is an asset, and in a way it is, but actually I believe that your house is an asset to the bank. Because an asset, the definition of an asset is something that produces an income. And although a house with a mortgage can save you on rent, and you can kind of see that as income, it's actually income for the bank. It's not income for you because you still have to pay your mortgage payments, as you can see in this sheet. At the beginning of your term, you have £100,000 outstanding. You pay £500 a month. Now, you don't pay £500 off of the 100,000. This is split up into interest and repayment. So here you can see your principal that you pay off is £208, but £291 actually goes to the bank. That's their profit, that's their income. So at the end of the first month, you're still left with £99,791. Now, if you calculate the interest till the end of the term, you pay £50,000 in interest, which is like half of your mortgage. That's crazy. So you buy a house, you know, you get a mortgage for 100,000 and you see maybe the house price goes up a little bit, but you actually pay back £150,000 for that mortgage, which is your principal that you borrowed plus the £50,000. Interest rates have risen. So now it's not 3.5% anymore. It's actually 4.5%. Well, actually, let's increase it by 1.24%. So it's actually 4.74 because that's how much it went up by. So, oh my God, can you see, like now you don't pay £500 a month, you pay £569 for the same thing. And as you could see before, it was £50,000 in interest. Now you pay £70,000 in interest over 25 years, which is absolutely crazy. Now, what can you do about this? Well, the number one thing that I found that you can do is to make overpayments. But again, check the terms and conditions of your mortgage provider. So let's say, okay, every month I decide to just put £100 extra in my mortgage account to pay it off. What does that do? So just £100 a month will help you to save £20,000 in interest. So it's actually the same amount as you pay. You pay £22,000 in early repayments, and that's the amount of money that you save. Like if we go back without overpayment, you pay £70,000 back. Now we just pay £100 a month more. Now you only pay £51,000. So the original payment, the original mortgage term was 25 years. Now, what do you think £100 a month does? Does it save 5 months payments, 12 months payments? No, it saves 6 years of your mortgage. So rather than paying it off in 25 years, you pay it off in 19 years. And this is just for £100 a month. Now, everyone can find £100 in additional income or savings. And if you don't know how, make sure you watch my previous video on the #1 way to beat inflation. I'll put the link down below. This is just an example with 100 pounds, but let's say I have 200 pounds extra a month to pay off. You paid off 9.75 years earlier. So rather than 25 years to pay off your mortgage, you pay it off in about 15 years. So isn't that crazy? For just 200 pounds extra overpayments a month, you save 10 years of your mortgage. How can we get 25 years down to 12 years? So let's try something. Let's try 250. No, you still have 14 years left. Let's try 300, getting close. 350. Yeah, that's nice. So every month, if I pay off an additional 350 to my mortgage account, I cut my mortgage in half. And isn't that amazing? Like, I don't know if you know the meaning of the word mortgage, but mortgage in French means debt grip, because so many people get mortgages for 30 or even 40 years now. It's absolutely crazy. And it's literally a debt grip. You're in the grip of the bank. Your house is an asset for the bank because the payments that you make go to the bank, and just a little bit is to pay it off. If you want this sheet, you can message me if you want it. I'm more than happy to send you a copy of this one, and you can play. Maybe you have a mortgage of 400,000. Maybe your interest is 5%. Like, you can do the calculations here, how much you can save off your mortgage, and yeah, find a way for you how you can cut your mortgage in half. So I hope that this was helpful. I hope that this was practical for you, and that it gives you some inspiration that you can cut your mortgage in half. All you have to do is find a couple of hundred extra bucks a month, which you have to pay anyway, but now you just pay it a little bit earlier, and that way you don't pay that much in interest. So thank you for watching. Make sure you subscribe and like. I would love to hear your comments, like how much have you saved off your mortgage by doing this calculation? Let me know in the comments below. And I'm looking forward to see you in the next video. Have a great day. Bye for now.